Okay, I make that 8 o'clock by my watch. So good morning, everyone, and a warm welcome to the webinar today entitled The End of the Tax Year, Act Now. And this webinar is brought to you today by us here at AVC Wise, working in conjunction with your employer. And today I'm looking forward to showing you about how, with some careful tax planning in combination with paying into the local government shared cost AVC, it offers a fantastic way to help you mitigate some of your tax liability for this tax year. But as you can see on the screen there, with that clock whirling away, time really is of the essence here, with only just over 2 months of this tax year remaining. So as you can see on the screen there, my name's Nick Pottinger, and I'm one of the retirement education specialists here at AVC Wise. And I've worked in financial services for over 20 years now, and for the last 9 of those years, I've been working exclusively in the local government AVC sector, where I've helped thousands of people like yourselves understand what a great employee benefit the AVC arrangement is and how they can make the most of it to save extra money for retirement. Now, for those of you here today that have joined this Teams webinar meeting as a guest, please do make sure you make a note of my email address on the screen there, as at the end of today's webinar, I'll be sending out an email with some important additional information. And if you've joined as a guest, I won't be able to see that you've attended. So for those of you that have joined as a guest this morning, just make a note of my email address there, nick.pottinger@avcwise.co.uk, and just get an email across to me just confirming that you've attended today's or this morning's webinar, and I'll get that additional information out to you. Just a few things to make you aware of before we start today then. So the content of this webinar is provided for educational purposes only and does not constitute financial advice. The information given is based on our current understanding of taxation legislation regulations, and any levels of and basis and reliefs from taxation are subject to change. And tax treatment is based on individual circumstances and may be subject to change in the future. And any examples used in the presentation are based on the national insurance rates that came into effect from the 6th of November 2022, and figures are for illustrative purposes only and calculated on a month-by-month basis and are not cumulative. And estimates are also not guaranteed. And lastly, fund values can fall as well as rise, and past performance should not be used as a guide to future performance. So what are we going to be taking a look at today then? Well, to give you a quick overview, I'm going to be showing you how you've still got time to take action and mitigate some of your tax liability for this 2022-2023 tax year by either starting to contribute into a shared cost AVC or by increasing your existing shared cost AVC contributions. And to give you a bit more of a specific idea of what we're covering today, I'm going to take a look at a reminder of the key benefits of the shared cost AVC arrangement. We'll cover some key facts about the tax year, including a bit of context as to how income tax and national insurance works in Scotland. We'll also take a look at the key benefits for you by paying into this shared cost AVC. And to bring it to life for you a little bit here, I'll be showing you some case studies with Joe and Jane to show the fantastic savings that can be made via the shared cost AVC. And lastly, and most importantly, I'll be showing you how you can make it happen and the next steps to take. Whether you're someone here today who's not currently paying into the shared cost AVC, or indeed if you're already making shared cost AVC contributions, I'll show you those next steps to take that you'll need to proceed. Okay, right, well, first of all then, let's just remind ourselves of the key benefits the local government shared cost AVC arrangement provides. So with a local government shared cost AVC, you're building up an extra pot of money that sits alongside your main local government pension, and potentially within limits, you can take the whole shared cost local government AVC all back as a tax-free cash lump sum when you take it at the same time as you take your main local government pension. And this is a huge deal for you, as you're the only public sector scheme that allows you to take the whole AVC pot of money you've built up all back as tax-free cash. And other public sector schemes such as the Teachers Pension Scheme or NHS Pension Scheme, their AVC members do not have that option. But you being a member of the LGPS, you've got this fantastic opportunity to build up this extra pot of money within the AVC that you can potentially take all back as a tax-free cash lump sum, as long as you take your AVC at the same time as you take your main local government pension, and as long as it's within certain limits. Shared cost AVCs also have flexibility as well. So whilst you're saving into a shared cost AVC, you've got total freedom to increase or decrease your contributions as you choose, be it wanting to perhaps pay in larger sums towards the end of the tax year to bring your total tax liability down, or just having the peace of mind in being able to adjust your contributions to accommodate those unexpected day-to-day expenses, such as your washing machine suddenly giving up the ghost or your car failing its MOT. Well, the AVC gives you that flexibility to make those changes. And when you get to the point in life that you want to access your AVC benefits in retirement, you've got an array of options available to you. You could just simply choose to take it all back as a tax-free cash lump sum, as I've already mentioned, or you could use it to provide a guaranteed pension income in retirement, amongst other options. The choice is yours, and you don't need to make a decision on how you want to utilise this AVC pot of money you've built up until you're ready to access it in retirement. So total flexibility there. You'll also receive tax relief on any money that you pay into the shared cost AVC arrangement on the basis the money you're paying into the AVC is due to be taxed by your employer. And as the AVC contribution is taken directly from your salary, any tax savings you're making are applied automatically. So no need to complete any confusing tax returns or self-assessment forms. It's all hassle-free. And finally then, your employer allows you to have your local government AVC arrangement set up on a shared cost basis via salary sacrifice. And what does this mean? Well, in simple terms, it means that you save on tax and national insurance on the money that you put in. And saving national insurance on AVC contributions is also something unique to the local government AVC arrangement too. So for shared cost AVC arrangement, you're benefiting from a double tax break by saving on income tax and national insurance each time you save into the AVC, on the proviso the money you're contributing into it is due to have tax and national insurance taken by your employer. So just before we go any further today, then let's just examine how the shared cost AVC arrangement works whilst you're actually saving into the arrangement. So with the shared cost AVC, you can only make contributions into it directly from your salary. So it's important to note that as we get to the end of the tax year, you can't just get the checkbook out and write a check for the amount you want to pay in and try and effectively backdate your contributions, as any contributions you make into this shared cost AVC always have to come directly from your salary. And it's for that reason that today's webinar is so important for those of you that do want to start making contributions or increase contributions for this tax year, as you've only got 2 months left, 2 pay slips left now that you can effectively contribute from. Now, any money you pay into this AVC arrangement goes into your AVC pot, which is an extra pot of money that sits alongside your main local government pension. And the objective is really to try and build up a pot of money as large as you can afford before retirement. And you've got the flexibility to vary your contribution, your AVC contribution amount, so you can increase or decrease as you choose. The maximum monthly contribution being up to around 60% of your salary, sometimes potentially higher, depending on what your salary is, with the minimum contribution allowed going into the AVC of just £2 a month. Now, the money you put into your shared cost AVC is then invested, and your pension fund, your local government pension fund, would have already chosen the company or companies responsible for investing your AVC contributions. And for everyone here today, your AVC provider will either be Prudential or Standard Life. And some employers do have a choice of the 2 different companies there, where you can choose which one to go with. But the vast majority of you here today will just have the one provider, either be Prudential or Standard Life. And when you go in, if you were to go into the application form on our website, avcwise.co.uk, you will be able to see who your AVC provider is there, whether it's Prudential or Standard Life or potentially both. Now, the shared cost AVC is an investment-based product, and as with any investment, you could get back less than what you've paid in, as funds can go down as well as up. But all the funds are there with the intention of increasing your AVC pot of money on top of what you've already contributed yourself. And the good thing for you is you've got total control over how Prudential or Standard Life invest your money. You can take as much or as little risk as you want, and I'll show you later today how you can access that information. But it is also worth noting that any investment returns you see within the shared cost AVC are also free of tax too. And then at the end, you've got the flexibility to choose how you take your AVC benefits in retirement. You could decide to convert your AVC pot of money into a variety of different pension products. But remember, as you're all members of the LGPS, you've got this unique option whereby you could just simply choose to take that whole AVC pot of money you've built up all back as a tax-free cash lump sum. Okay, so let's just take a look at what it would actually cost you from your salary to pay an amount into a shared cost AVC by taking a look at an example here. So if you're an intermediate rate taxpayer, it means that you pay tax at 21% rather, on a proportion of your earnings, and national insurance at 12% on any earnings above £12,570 within the tax year. So if you're someone in a similar position, and you wanted to save £100 a month into a shared cost AVC, it would actually only cost you £67 from your take-home pay to do it. And that actually amounts to a massive 49.25% uplift to your savings as soon as the money goes into the shared cost AVC. And if you're a higher rate taxpayer, a 41% taxpayer, the savings are even greater still. So if you're a 41% taxpayer, assuming the full £100 going into the shared cost AVC was due to be taxed at 41%, it would actually only cost you £57 from your take-home pay. And that actually equates to a quite remarkable 75.43% uplift to your contributions as soon as the money goes into the shared cost AVC arrangement. Now, some of you here today might be currently saving money into a savings account or a cash ISA. Or at the moment, you'll probably be lucky to be getting around 2 to 3% interest on your savings. With the shared cost AVC, you'd be benefiting from that huge initial uplift as the money goes into the arrangement. Over 49% if you're an intermediate rate taxpayer, and over 75%, as you can see on the screen there, if you're a higher rate taxpayer. So this arrangement then really does allow you to save additional money for retirement in the most tax efficient way possible. Now, I appreciate the shared cost AVC arrangement is a pension arrangement, and therefore you can't access the money in a pension arrangement until you're at least over the age of 55. But the comparison there is pretty stark when you're comparing the savings that you could be making within a shared cost AVC in comparison to other savings vehicles you've got access to in the marketplace. And this is what your employer set up for you, the ability to save money from your salary, allowing you to save on tax and national insurance on your contributions, which is an absolutely fantastic benefit for you. Okay, so remember then, we're now approaching the end of the tax year. And as a result, you've got this limited time left in the next couple of months to make a difference and either start paying into a shared cost AVC or by increasing your existing shared cost AVC contributions. As once we're out of this tax year, any tax relief you're entitled to from this year is lost for good. And let's just take a quick look at some key facts for this tax year then. So this tax year then, running from the 6th of April 2022 to the 5th of April 2023, the first thing to remember is that you are allowed to earn a certain amount of income within this tax year before you're due to start paying any income tax. It's called the personal allowance, and this tax year the standard personal allowance is £12,570. So typically you're allowed to earn £12,570 this tax year, before you're due to start paying income tax. And anything above that amount, you would start to pay income tax at the relevant amounts due. And it might be worth taking a look at your payslip, because ultimately it's your tax code on your payslip that sets out the amount that you're allowed to earn this tax year before you're due to start paying tax. And if you see your tax code on your payslip as S1257L, that means that you've got this standard personal allowance of £12,570 for this tax year. But if you have a look at your payslip and see anything different to 1257L or S1257L, it would mean that your personal allowance is either more or less than that standard personal allowance amount. And there could be many reasons for this. It could be that you're currently in receipt of other income streams where either part or all of your personal allowance is being applied against that, or it could be that you've maybe underpaid tax in the previous tax year. And there are a multitude of different reasons as to why your tax code might be different to the standard one. And if you take a look at your tax code and don't think something's quite right, the best course of action is to just get in touch with HMRC to query it with them. And it's not only income tax that you're due to pay from your salary, of course, because you'll also be typically making national insurance contributions too. And since July last year, July 2022, the amount you're allowed to earn before you're due to start paying national insurance has been equalised with the personal allowance. So any income that you earn above £12,570, you'll be paying national insurance on of 12% until your annual income reaches £50,268, where anything above that would start to have national insurance contributions of 2%. So if your annual income is above £50,268, you'll be paying a mixture of 12% and 2% national insurance. And it is also worth pointing out, as some of you may already be aware today, the personal allowance of £12,570 has now been frozen until 2027. So with that personal allowance being frozen, every pay increase you receive between now and then will mean that you'll be paying more tax than ever before and never been more likely to have started to drift into those intermediate rate and higher rate tax bands where you start to pay a higher percentage of tax on your earnings. And with the recent pay award, the majority of you should have received at the end of last year, you may now find that you're paying more tax than you expected to this year. And that's where this shared cost AVC arrangement really does come into its element and provide a fantastic opportunity to claw back some of that tax and as a result give yourself more money to enjoy spending at your point of retirement. Now, as I've already mentioned several times today, you've only got this limited amount of time left to relieve yourself of any tax you're due to pay this tax year, as you can only make shared cost AVC contributions from your salary. So we've now only got your February and March salaries left this tax year that deductions can come from. And that's why it's vital for you to take on board that making contributions from your 2 remaining pay slips is the only opportunity you've now got to make those vast savings I showed you a moment ago by paying into the shared cost AVC and reducing your tax liability for this 2022-2023 tax year. So the key message is you need to act now, because once we're out this tax year, that opportunity to make those tax and national insurance savings for this tax year has gone for good. So before we go any further today, then, let's just take a look at the amounts of income tax you're due to pay, which of course is dependent on your earnings. Now, sometimes there is a bit of a misconception that as soon as your income goes into the higher rate tax bracket, you start paying higher rate tax on all your earnings, but that is absolutely not the case. So as I just mentioned, the standard personal allowance, the amount you're allowed to earn in a tax year before you're due to start paying tax, has been frozen at £12,570 until 2027. So if your yearly income, your annual income is below £12,570, you shouldn't be paying any income tax at all at the moment. Now with Scotland then, your income tax system works on an increasing sliding scale basis. So any earnings between £12,570 to £14,733, you'd be paying 19% income tax on, starter rate tax that's called. Any earnings between £14,733 to £25,689, you'd be paying 20% tax on, that's called Scottish basic rate tax. And any earnings between £25,689 and £43,663, you'd be paying 21% tax, intermediate rate tax there. Now, for any income that you earn between £43,663 to £150,000, that proportion of your income would be coming into the higher rate tax bracket and be taxed at a rate of 41%. And then if you're lucky enough to earn over £150,000, that's where that segment of income would come into the additional top rate tax of 46%. And it's also worth mentioning that for any income that you earn above £100,000, your personal allowance would actually be reduced at a rate of £1 for every £2 of income in excess of £100,000. And that would actually result in the standard personal allowance of £12,570 being completely wiped out by the time your income reaches £125,140. Now, I don't expect that's an issue for most of us that we need to consider here, but I have included it for compliance purposes at the bottom of the screen, just in case. But as you can see there, whatever tax band or bands you find yourself in, you're handing over a fair chunk of your money to HMRC before your salary even ends up in your bank account each month. And by paying into a pension arrangement like this shared cost AVC, you get to keep more of the money you've worked hard for, and where paying into pensions help mitigate your tax liability by getting tax relief on your pension contributions. And of course, the contributions you're already making into your main local government pension do qualify for that tax relief too, as any UK-based pension arrangement would. But with the local government shared cost AVC, you're not only getting your income tax relief, but in addition to that, you're getting your national insurance savings too. So ask yourself then, why wouldn't you want to make use of this arrangement and make some big tax savings this tax year before it's too late? Whether you're someone here today who's not currently contributing into the shared cost AVC and looking to get it set up, or if you're someone who's already contributing into the shared cost AVC arrangement and looking to increase your existing contributions, the shared cost AVC really does allow you to make those vast savings we talked about earlier, whereas an intermediate rate taxpayer, you're benefiting from an effective uplift of over 49% as the money goes into the arrangement, and as a higher rate taxpayer, a 75.43% uplift. And remember, with you all being members of the local government pension scheme, you get to potentially take that whole pot of money you've built up within the AVC all back as a tax-free cash lump sum at the point of retirement. So it really is a fantastic deal. And just to bring this to life a little bit here, I just want to show you the kind of saving you could make by supercharging your AVC contributions for these final couple of months this tax year. So first of all, let me just introduce you to a colleague of yours called Joe. So this is Joe, and he's on a salary of £40,000. So a proportion of his income is in the intermediate rate tax band of 21%. And Joe's been paying into the shared cost AVC throughout the whole of this tax year so far, with a steady contribution of £250 a month. And as Joe's been making income tax and national insurance savings on that £250 contribution, that contribution has actually only been costing him £167.50 a month from his take-home pay. So a nice £82.50 monthly saving for Joe there. However, the more you contribute into the shared cost AVC, the more income tax and national insurance you save on. And at the end of the tax year, as the end of the tax year approaches, Joe decides he really wants to make the most of the shared cost AVC arrangement and supercharges AVC contributions for the remaining 2 months of the tax year. So Joe increases his contribution from £250 a month to a rather hefty £1,000 per month for just his February and March salaries. Now, that £1,000 contribution only cost Joe £670.29 from his take-home pay. So a massive saving there. That actually means Joe has saved a very considerable £659.42 in income tax and national insurance contributions in just those last 2 months of the tax year. And yes, that is quite a high amount that Joe increased to for those final couple of months. And it might be that he can't afford to see that kind of reduction in his take-home pay. But if Joe has savings in perhaps a savings account or a cash ISA that isn't doing much for him at the moment, and the value of those savings are actually in reality being eroded due to the pace and rate of current inflation, he could live off some of those savings whilst he's paying a greater proportion of his salary into the shared cost AVC, as it would typically be the smart move to make in those types of instances. And now let's just take another look at another case study here with another of your colleagues called Jane, who happens to be a 41% higher rate taxpayer. So this is Jane, and she's on a salary of £60,000 a year. And like Joe, she's been paying into the shared cost AVC for the first 10 months of the tax year at £250 a month at a cost to her of just £142.50 a month due to those 41% tax savings and 2% national insurance savings. And just like Joe did, Jane decides to supercharge her AVC contributions in the final 2 months of the tax year and increase her contributions to £1,000 a month. And as Jane's a higher rate taxpayer, it costs her even less from her take-home pay to pay that £1,000 into her AVC, just £558.39 from her take-home pay to contribute that £1,000 into the shared cost AVC. And in just those 2 months then, Jane makes a huge £883.22 saving in income tax and national insurance. So that's £883 of her salary that she gets to keep instead of handing across to HMRC. And to boot, Jane knows that she can take all that money that she saved in the AVC all back as a tax-free cash lump sum at the point of retirement. Now, the 2 case studies we've just had a look at there are showing the savings that can be made in these final 2 months and are based on their respective salaries of £40,000 a year for Joe and £60,000 for Jane. And the savings that you can make, depending on what your salary is, may differ. But you really can see there that the incredible savings that can be made just by increasing or starting to pay into the shared cost AVC in these final 2 months of the tax year. And if you would like to find out what a contribution will cost you from your take-home pay, we do have a very useful calculator on our website. So if you go to our website, abcwise.co.uk, you'll find a calculator on the homepage where you can enter your salary and your tax code, and it will estimate the cost from your take-home pay to make a contribution of your chosen amount into the shared cost AVC. And to finish up on today, then, I just want to share with you another fantastic potential benefit of the shared cost AVC. So for those of you here today who are currently claiming child benefit, you might not be aware that if your salary goes above a certain amount, it'll start to impact on the amount of child benefit you're eligible to receive. So just coming back to Jane here, she happens to be a mum with 2 children and is claiming £1,885 tax-free per year in the form of child benefit. However, due to Jane earning over £50,000 of adjusted net income this tax year, she needs to pay the high income child benefit charge. And just to let you know, the high income child benefit charge actually wipes out any child benefit entitlement you're claiming if your adjusted net income is above £60,000. Now, this is where the shared cost AVC has an additional string to its bow and can help you save even more money. So with Jane here, as long as she pays a sufficient amount into a shared cost AVC within the tax year, she can reduce her adjusted net income to below £50,000 and get to keep the full amount of child benefit she's receiving. And for those of you here wondering what adjusted net income is, well, adjusted net income is your annual salary or earnings minus any pension contributions you're paying. So with Jane, her salary being £60,000, she needs to make sure that she's paying £10,000 into her pensions this tax year for a combination of her main local government pension contributions and the shared cost AVC. And as long as she does this, she gets to keep the full child benefit entitlement for her 2 children of £1,885 for this tax year and not incur that high income child benefit charge. And remember, with Jane here, she's a higher rate taxpayer, so she's not only getting that 41% income tax saving along with the national insurance savings when she contributes into the shared cost AVC, that equates to that massive 75.43% uplift on her contributions, but she's also now making this huge other saving by not incurring the high income child benefit charge by making sure her adjusted net income comes in below at £50,000, working on the assumption that her partner's adjusted net income is also below £50,000 for this tax year too. So if you're someone here today currently claiming child benefit and have a salary that takes you above the £50,000 adjusted net income threshold, this is yet another fantastic plus point with this shared cost AVC arrangement that allows you to save even more money. Just make sure you've done some careful tax planning to mitigate that high income child benefit charge before the end of the tax year. But as we've seen today, no matter what your personal circumstances are, there are tremendous savings to be made across the board just with those incredible income tax and national insurance savings alone. Okay, so importantly then, what are the next steps? So for those of you here today that aren't currently paying into a shared cost AVC, you'll need to complete a new AVC Wise application. So the first step is to go to our website, abcwise.co.uk, and log into your account. And on the home page, scroll to the bottom of the page and you'll see the application buttons, and just click on the new application button there. You'll then just need to complete your details on that application form, and the application form will also ask you what fund or funds it is that you want to invest in. And within the application form, you'll find a link to the fund guide, be it for Prudential, be it for Standard Life. That's where you'll find the fund guide information. So if you click on that link on the application to download the fund guide, you'll be able to see all the different funds you're able to invest in. And you can select one fund or multiple funds. You're not tied into the initial investment choice you make on your application. You can always change your fund choice at any time. And typically on that fund guide, what you'll see is a list of funds kind of ranging from minimal risk all the way up to higher risk. And you can choose a fund or funds that you want to invest in based on what your attitude to risk is. Now, as I mentioned, you're not tied into the initial investment choice you make on your application. So if you're someone here today who really wants to get this shared cost AVC arrangement set up, but aren't quite sure about what investment choice to make, There would be nothing to stop you from, say, going into say a minimal risk fund to begin with, like the cash fund, because you can always change your fund choices at any time at a future point. You're not locked into what you initially put down on that application. Now, once you submit your application, that will then make its way to your employer for them to do their checks on, and then your contributions will be set up with your AVC provider, be that Prudential or Standard Life, and then your contributions will start to be taken from the following month. So for everyone here today, if you did an application in the next week or so, I would say the next kind of week and a half, you'll make it in time for your February salary. Now, if you're someone here today that's already currently contributing into the shared cost AVC arrangement and are perhaps looking to supercharge your AVC contributions for the final 2 months of the tax year, like we've seen with our 2 case studies today, it is a similar process. Again, just go to our website, avcwise.co.uk, and log into your account. Head to the My Shared Cost AVC page and click on Amend Contribution Amount and just enter your new total desired monthly contribution. Then your amended contributions will start to be taken from your next salary. So as I mentioned, I would say act as soon as possible and get your amendment request in now to ensure that you make that February salary. And then if you're purely just looking to pay an increased amount in for your, say, your February and March salaries, you can always log into your ABC Wise account around kind of mid-March time to adjust that contribution amount back down to the amount you might be looking to pay in from the new tax year in April. Now, we appreciate that some of you here today may need some extra help when it comes to either setting up a shared cost AVC or amending your existing AVC contribution amounts. So you do have the opportunity of booking a one-to-one meeting with us, and that might be with myself or one of my fellow retirement education specialists here at AVC Wise. And this meeting is completely free of charge. And the meeting lasts up to around 20 minutes or so, and it takes place on Microsoft Teams. And it's where we can give you a helping hand to either set up your shared cost AVC or help you with increasing your existing shared cost AVC contributions. And we can look at things such as working out the maximum amount that you can hold in your AVC and take all back as tax-free cash, or looking at what you can pay in to maximise your tax and national insurance efficient contribution. We can also look at things like the annual allowance, which is the amount you're allowed to save into pensions within a tax year and get tax relief on, which is typically £40,000. So essentially at this meeting, we're really just ensuring you're making the most of the unique opportunity the shared cost AVC presents and how you can benefit in these final couple of months of the tax year. Now, I will stress this option of a meeting is really only available if you're ready at this moment in time to either set up an AVC now or increase your existing AVC contributions now. I'd say if you're not in a position to do that, just hold off booking a meeting with us for the time being. As you can expect, we are quite busy at this point of the tax year, and we want to make sure that we're getting around to seeing the people that want to take action this tax year. So, as I say, if you're not in a position to either set up an AVC at the moment or increase your existing contributions at the moment, just hold off booking a meeting with us for the time being, and just come back to us at a future point when you are in a position to do those things. Now, if you are looking to set up this meeting with us, then you can do that by going to this web, and this website address will be appearing on the screen in a moment, but it's www.avcwise.co.uk/meeting. So if you go to that website, you'll be able to book yourself onto a meeting at a convenient time and a date for you. Now, some considerations here for us to be able to help you at this meeting. Please do ensure that you've got access to an LGPS projection to your desired retirement age. If your annual benefit statement has a projection for an age later than your intended retirement age, you can always log into your LGPS self-service portal to get a projection to your desired retirement age there. Also, if you've already got an AVC arrangement already set up, please try and get an up-to-date valuation on what your AVC pot is currently worth. And we'll also need you to have access to an up-to-date payslip. And please also do consider what you can afford to see less in your take-home pay each month too. And as you can see then, the bottom left-hand corner of the screen, we're not providing any financial advice or investment advice at the meeting, but we can give you factual information and help you on your way to either applying for the shared cost AVC or amending your existing shared cost AVC contributions. So just to reiterate, if you'd like that meeting with us before you do that, send us or go to that website address, www.avcwise.co.uk/meeting, and book yourself a meeting at a convenient time and a date for you. Just before we get to questions then, I just want to go through some useful pointers here. So as I've just mentioned there, if you're someone here today who's looking to get an AVC set up or increase your existing contributions before the end of the tax year, and would like that meeting with us, just head to that website address at the top there, www.avcwise.co.uk/meeting, and you'll be able to book yourself a meeting with us there. We've got a live chat facility on our website where you can get a quick answer to any questions you might have. Or if you prefer the more traditional contact method, you can give us a call on that telephone number. We're typically open between 9 AM to 5 PM weekdays. And if you're looking for more details about how your main local government pension scheme works, you can find those details on the website towards the bottom there, scottlgpsregs.org. That is a generic website, but it does go into a bit of detail about how your main local government pension scheme operates. And if you're on social media, you can give us a follow here at AVC Wise on Twitter or on Facebook at the respective addresses at the bottom of the screen there. Okay, right, well, let's see if we've had any questions. Bear with me a moment. Okay, so Ian has asked, can you split the amount between different levels of risk, e.g. 25, 50, 25 between low, medium, high risk? Yeah, good question, Ian, and absolutely you can, all right? So, you know, you've got total control over where you're investing in within the shared cost AVC. And as I mentioned, you know, you've typically got these kind of different risk categories. You've got minimal risk, lower to medium risk, medium to high risk, and then finally a higher risk category. And yes, you could, you know, exactly as you've kind of said there, you could have 25% going into a minimal risk fund. You could have 50% going into a medium risk fund and 25% going into a higher risk fund. You've got that total degree of control over where you're investing your money. And you can always change your investment choices at any time. There are no charges to switch between the funds, typically speaking. So yes, you can have a different split of different fund choices, which some people like because you're not putting all your eggs in one basket in those instances. And a question here, can you specify non-fossil fuel investment? Okay, well, potentially, I mean, with the fund choices you've got, at the top end of the kind of risk scales in higher risk and lower to in higher risk and medium to higher risk, you know, typically those are going to be funds that are just purely investing into company shares. Okay, otherwise not all the funds are investing into company shares. You know, you've got some funds that are be investing into gilts, loans to the UK government. You could have funds that are investing into corporate bonds, which are loans to companies. You could have funds that are investing into kind of cash type assets, but ultimately, you know, they're with some of the fund providers, for example, Prudential, they do have, I think it's in medium to high risk. They've got a fund called the Positive Impact Fund, where the fund manager does have a restriction as to what companies they can invest in. And if you would have a look on the fund guide on the website, you'll see that fund choice there. As I say, it is a medium to higher risk fund, but ultimately with that fund, the fund manager can only invest in companies that demonstrate good environmental, social and governance policies. But otherwise, as I say, you don't need to be even investing into a fund that is investing into company shares if you don't want to. Let's see if there's any other questions here. Okay, so I've got a question here. What are the fees? Okay, well, the only fees you've got in relation to the AVC are in relation to the fund or funds that you decide to invest in. So all the funds have what's called an annual cost and charge, and that's essentially what Prudential or Standard Life charge to manage the fund that you're in and hopefully obtain further growth for you. Now, the annual costs and charges do vary from fund to fund. I would say, you know, with Prudential, it's typically kind of between 0.55% to 1% as an annual cost and charge. With Standard Life, if your AVC provider Standard Life, their annual cost and charges are a bit higher. They're typically kind of 1 to 2% as an annual cost and charge with Standard Life. But that's the only cost and charge you've got in respect of the shared cost AVC in relation to those annual costs and charges on the funds. And of course, the intention is the funds are there to hopefully have performance greater than the annual cost and charge, because as long as they do, then your fund has technically grown in value due to the fund performance. Another question here, what happens if you die before you access your funds? Yeah, good question there. It's one we often get. And it's a bit of a morbid question, isn't it? But it's one that certainly needs to be addressed. So essentially, when you joined your main local government pension scheme, you would have completed an expression of wish form for your main local government pension in relation to your main local government pension benefits. Now, this shared cost AVC is a local government AVC, so it's covered by that same form that you should have already completed, that expression of wish form within your main scheme. So however you've nominated on that expression of wish form, if you were to die before accessing your AVC pot of money,
your AVC pot of money would be payable in its entirety, typically as a tax-free cash lump sum to the person or persons you've already nominated on that expression of wish form within your main local government pension. All right, so your AVC pot is not lost or anything like that. As I say, it's fully payable to the person or persons you've already nominated on your expression of wish form within your main local government pension. Okay, let's see if we've got any other questions here. Bear with me a second. Okay, I think that is all the questions we've had. So let's get today's webinar wrapped up for you in that case. Okay, so I hope today then's been a timely reminder about the fantastic benefits of the shared cost AVC and the benefits that it provides. It's an arrangement that's exclusively available to you, with you all being members of the LGPS, and it allows you to save additional money for retirement in a remarkably tax efficient way. And we've seen today the vast income tax and national insurance savings you can make as the money goes into the arrangement, and then potentially you get to take that all back as a tax-free cash lump sum at the point of retirement when you take your AVC at the same time as you take your main local government pension. And as the end of the tax year is now rapidly approaching, you've all now got a fantastic but time-limited opportunity to either start contributing into the shared cost AVC or by supercharging your existing shared cost AVC contributions over the next couple of months. And everyone here today, you all took that first step in making a difference to your retirement and your tax position by coming along to the webinar and learning about the fantastic savings that can be made in time for this tax year. Now make sure you take that vital second step by either completing a new shared cost AVC application or by increasing your existing shared cost AVC contributions now, whilst there's still time left in these final 2 months. Okay, well, thank you for your time today, everyone. Appreciate it was early in the morning today, so I hope everyone had their coffee and was wide awake, but thanks for your time today. Hope you found today useful and have a great rest of the day.